This is great news for the shareholders because Tata Motors finally has decided to demerge its companies into two separate entities. One will house the commercial vehicle space and the other one will house the passenger vehicle space, which will include passenger vehicles, electric vehicles and JLR that will all be under one company. But the big question we're asking this afternoon is why did they decide to do the demerger now? In terms of a timeline, if you look at it, all three companies have been increasing both their revenues as well as their profitability over the past couple of years. First, let me explain to you what the business is like currently. In FY23, if you look at it, the largest chunk of their revenues comes from Jaguar Land Rover, which is 65%, followed by the commercial vehicle business and then the passenger vehicle business. However, if you look at the passenger vehicle business, which is now growing very fast in the domestic space, the turnaround for the passenger vehicle business has been quite, sort of astounding over the last many years. The market share has gone from mid-single digits to 13.5% as of 9 months of FY24, and they now have 75% market share in the electric vehicle space. Even if you look at the EBITDA margins of the passenger vehicle business, right? In FY20, they had negative 9.4% EBITDA margins, and now that has risen to 6.7% in FY24. So this is the kind of improvement that we've seen in the passenger vehicle business. JP Morgan put out a note where they said that the India business is valued at 480 rupees a share and the passenger vehicle business is valued at 15 times EV to EBITDA. Let's move now to the Jaguar Land Rover business, which is back to health in a big way. There's been a substantial improvement in the last few years. In fact, in the quarter gone by, JLR raised its FY24 EBIT margin guidance for the second consecutive quarter, and now the EBIT margin is expected to be over 8% for FY24. Not just that, the balance sheet has been improving for Jaguar Land Rover as well. They continue to expect free cash flow of over £2 billion in FY24, and the net debt is expected to reduce to less than £1 billion by the end of FY24. Now, let's also talk a little more about the CV business, right? Over there, if you look at it, this is how the margin trajectory has been for CVs. In FY20, they barely enjoyed 4% margins. As of by the end of FY24, Motilal Oswal has forecasted a 10.6% EBITDA margin in the commercial vehicle space. And the commercial vehicle business is valued at 9 times EV to EBITDA. Now, let's look at what brokerages are saying. UBS put out a view where they said that this is a positive for the company. It definitely simplifies the structure, unlocks shareholder value, but they don't see a material value unlocking because the price has already risen quite a bit. Morgan Stanley says the demerger reflects confidence in the passenger vehicle business being self-sustaining. JP Morgan says the demerger might lead to better value discovery, and InCred says that yes, the sentiment will be positive, but there are no major changes in the business compared to what we've seen earlier. Let me leave you with the target prices. Remember, Tata Motors is now above 1,000 rupees, but if you look at it, most on the street continue to be at around 1,000 rupees plus on on the stock. One that is missing, of course, here is Motilal Oswal, where they have downgraded the stock to a neutral this morning with a target price of 1,000. So, slight bit of caution over here, but otherwise, most brokerages seem to be bullish on the stock.